PersonalFN is privileged to bring to you Mr. Taher Badshah, the Director and CIO Equities at Invesco Mutual Fund. Taher holds a total of 27 years of experience in the Indian equity market. He has to his credit an MMS from SP Jain Institute of Management and a BE degree in electronics from University of Mumbai. At Invesco Mutual Fund, he currently manages the Invesco India Contra Fund, the Invesco India Growth Opportunities Fund, the Dynamic Equity Fund, Invesco India Equity and Bond Fund, Invesco India Small Cap Fund, and the recently launched Invesco India ESG Equity Fund. Cumulatively, Taher actively manages assets of over rupees 13,500 crore in these 6 schemes, and many of them have displayed an impressive performance track record. Being primarily responsible for the equity management function as the CIO, he also oversees other equity-oriented schemes at the fund house. Before joining Invesco Mutual Fund in Jan 2007, Taher worked with Motilal Oswal Asset Management as head equities for over 6.5 years. His earlier stints include organizations such as Kotak Mahindra Investment Advisors, ICICI Prudential Asset Management, and Alliance Capital Asset Management. Taher is known to have an eye for quality equity investing, going against the grain with his contra style, follows a bottom-up approach, and not necessarily chases momentum. He has defined robust investment processes and systems at Invesco Mutual Fund. So, Taher, thanks for joining.
Thank you very much, Vivek. Thanks for having me on this platform, and happy to be here.
Okay, so we'll discuss the theme that is navigating the waves of COVID-19. So my first question to you is, when the novel coronavirus or COVID-19 cases were reported in Wuhan, China, towards the end of the calendar year 2019, did you envisage it spreading to the rest of the world, turning to be a pandemic and causing a havoc?
No, I don't really think so. I think we were all very, naive as far as the lethality of this disease is concerned, and we have had past instances of viruses and epidemics having started out of out of that region. We've seen that in the case of the bird flu virus and the virus which originated in Hong Kong a number of years ago, and so we've had that situation in the past, and in those occasions we've not had a scenario where it has spread to the rest of the world. So I think that is what we went by. I distinctly remember towards the end of 2019 and early part of 2020 also, we were in a mode of denial. And we started to only think about this disease being confined to those parts of Asia, China, and some parts of Asia. But we didn't really expect it hitting the Indian shores. And I think even before it hit the Indian shores, it actually hit the parts of Europe first. So it first traveled to the European continent and places out there, and after which through the Middle Eastern route, etc., it then started to kind of hit the shores of India as well. So no, I would not I'll be very frank with you that this is something which was quite unanticipated as far as it's converting into a pandemic, and then the subsequent havoc it created, not just in other parts of the world, but even in India as well.
Okay, so the first case of COVID-19 in India was reported in Kerala. That was on Jan 27, 2020. And in the financial capital, Mumbai, it was recorded on March 11, 2020. And 2 weeks later, Prime Minister Modi, he announced a nationwide lockdown. After which the Indian equity market stumbled and hit a low of 25,918 on the Sensex on March 23rd, 2020. So how did this impact the equity-oriented mutual fund schemes of Invesco Mutual Fund? What were the risk management measures that you followed that helped reduce the losses?
Well, I think the good part was that all throughout, we as a house have been a very process-oriented house, and we've generally kept to our investment frameworks throughout the last many years of our existence, over the last 12, 13 years of our existence. And we followed the same process very consistently during all these years. This process has an inbuilt mechanism in a way to counter uh, extraordinary situations like these. And basically, while of course this was something which was completely unprecedented in terms of the event which happened, we've that this is something which has happened once in a century. But I think, despite that, I think our processes held up pretty well during that period of time, particularly during the period between March and May. We were able to contain the impact of the markets onto our portfolios to a reasonable degree, thanks to once again the fact that we've been using this process, which is basically in a way a risk mitigating mechanism by itself. Uh, it is a process which essentially allows us to uh, filter out low quality companies. It allows us to avoid accidents, and that is something that we've experienced uh, it over the number of years that we've been using this process. So even during that phase between March and May of 2020, when the markets were exceedingly volatile and we saw nearly a 40% drop in equity valuations and equity markets during that period in India and elsewhere around the world as well. I think we had been able to display some reasonable amount of resilience thanks to the fact that we've generally preferred high quality companies. We've generally, looked at franchises which have got good competitive advantages, and that is exactly what the markets uh, were trying to chase during that period of time, because the scenario was exceedingly uncertain. We and it was not just uncertain from a financial and an economic standpoint. Uh, More importantly, this time around, in this crisis, as we all know, it has been a health related crisis, and as a result of which, more than financials and the economics of businesses and those kind of pressures, markets were worried about lives and livelihood. So it was a larger emergency, and it was a relatively more a difficult situation to handle. So I think there was this whole you know uh, attraction of the markets towards businesses which would have longevity, who would display resilience, who would be having strong balance sheets to be able to wither the crisis at that point in time. We also did not know, in our wisdom as a human race, we in our wisdom we didn't really know as to how long will this crisis last, how long would these lockdowns which were prevalent across most countries around the world will go on. We didn't know how quickly businesses will be able to resume normal operations. So there was a significant amount of uncertainty at that point in time, and therefore markets gravitated towards businesses where maybe the next year, 2 years, perhaps even 3 years, would nothing would happen, and yet can you be reasonably certain that these businesses will be alive and will be able to prosper post 2 years, 3 years of loss of business and cash flow? So this is exactly what our process has been designed for, to try and identify companies which are a combination of resilience, decent growth, and we are not necessarily always chasing very high growths. Um, we are not about buying, as you alluded to a little while early, that we don't really chase momentum, nor do we chase growth momentum, neither do we chase price momentum. So I think that is exactly the kind of businesses that we have been preferring, and I think they stood out during that period of time when the world was in a really uncertain place. And I think that is, at one level, I would say, the most important thing which allowed us to defend ourselves during that period.
Great. So, Invesco Mutual Fund launched two schemes: Invesco India Focus 20 Equity Fund in September 2020, and Invesco India Global Consumer Trends Fund of Fund in December 2020. So, what was the rationale behind adding these two new schemes to your product basket when the Indian equity market had already scaled up remarkably?
So, the first fund, which is the Focus 20 Equity Fund, is something that we had in the works even before the pandemic. And We had actually filed for that product well into the later part of 2019 itself. Unfortunately, because of and we were essentially thinking of launching it in the early part of 2020. But unfortunately, pandemic hit us, the COVID hit us, and we didn't really have a choice but to hold it back for a while. But this is something which was always in the works. This is also something which, as a strategy, has been in a way close to my heart, because in my earlier avatar at Motilal Oswal, and in my past experiences, we've dealt with products which are high conviction, highly focused strategies, limited number of stocks. This is something which has always excited us and excited me in person, at a personal level as well. So we were always looking for an opportunity to launch this product, because we thought that we had the necessary tools and the wherewithal and the processes to be able to support a strategy like this. This is a strategy which is quite unique. At one level, it is about displaying a lot of conviction, and it is therefore very important that you have very strong processes within, in order to be able to run this kind of a strategy, because they tend to be a little more volatile. I wouldn't say they are risky, but they are a little more volatile. They can turn risky if you do not manage that product well, and if you really do not delve deep into the companies that you buy, because it's a very high it's a very focused strategy with a very limited number of stocks, high weightages, high exposures, significantly deviating from the underlying benchmark. And therefore, any one or two ideas which don't work out, or probably fire in the wrong way, uh, it can create a lot of problem for the portfolio as a whole. So it is not to say that we will, get all our stocks selection right, and we will make money in all of them. But this is a portfolio where you really need to be very alert about avoiding fatal accidents. You can go wrong on certain calls. Your business case may not work out the way you expect, and you could see a correction in those names, and you might lose money. That is not what I'm referring to. What I'm referring to is permanent losses. What I'm referring to is fatal losses, where your complete judgment of a business is incorrect, and it leads to the kind of losses which of the magnitude of 70-80% on the value or the value of the stock, or the value of the business. So these kind of things do not necessarily hurt you in a well diversified portfolio, where your exposure might probably be in the vicinity of 2-3% on an average, and may go up to 5-6-7% at best. Here you are actually starting with an exposure of anything more than nothing less than 3.5-4%, and going all the way up to 9%. And more so, we wanted to differentiate this product a little more, so we sharpened the portfolio even further. Within our competitive basket, we used to have we saw that funds were generally operating with about 25 to 30 stocks. We wanted to kind of be a little more distinct and sharply positioned, so we actually introduced a 20 stock concept, and we therefore went to the lowest extreme of the number of stocks that we could have in that particular category. So in a way, this is, I think, probably the only fund which runs with a 20 stock, maximum 20 stock portfolio. I can't own anything more than 20 stocks at this point. So I think that conviction of running this kind of a strategy was always there in the mind. And as soon as we saw the first opportunity with market stabilizing, and more than market stabilizing, because this was never a product which was timed with any market level in mind. We always wanted to launch it. Like as I said, we were just waiting for, other things, such as ability to operationalize the product, and being able to see our sales force being able to deliver on it, and people starting to resume normal work. That is what we were essentially looking forward to. So as soon as in June, July, when we got out of the lockdown and things started to normalize, we said that let's proceed, because we were, and by which time I think the markets had already climbed from a low of 7,500 on the Nifty, I remember, to more like 11,000. So the market had probably already done maybe 40 odd percent or 50 odd percent since then. And yet we went ahead with the conviction that, look, we are not necessarily doing this for the next year or the next 2 quarters. We are in it for the long haul, and this is a product which is positioned for the next 3, 5, 10 years. And so therefore we never were kind of held back or had any apprehensions regarding the market levels, and therefore we should time it out. And as we stand today, we are up about 35% on the NAV even since then. So In hindsight, it is just that it's good that we traveled that distance and we took that conviction and went ahead with that product. So I think all these things, our primary conviction, our tools that we have at our end, since we had a very robust process at our end, we were pretty comforted with the fact that look, we can run such a high conviction strategy because we do we think our due diligence is reasonably strong in general. So I think that is something which was the bedrock, that was the backbone on the basis of which we got that confidence, and plus my own conviction that look, I've done this in the past and I can manage it, and that's something which excited us. All these things put together is essentially what led to the launch of the product.
And any insights on the Invesco Global Consumer Trends Fund of Fund?
Oh, that's a very interesting thing as well. So good that Vivek, you brought it up. It's been our endeavor in general. If you cut across all our products to bring something which is differentiated over a period of time and something which is which at one level adds value to the ultimate client, and it at one level also leverages upon not just Invesco India, but being part of a global firm, a global investment firm, which is among the top 10, 12. Standalone investment management firms in the world, and which has a lot of a whole list of products, an array of products which are available in different forms, which we can leverage upon through the vast experience of these funds having been managed at a global level with scale and size of billions of dollars. So we thought that this is something which we should leverage upon, and this is a fund which at one level is also very has a couple of unique propositions. So one, of course, being the fact that look, it allows you to diversify your equity exposures beyond India. That is one at one level, and yet it allows you to actually play the consumer trends in India as well. And I'll explain to you how. This fund, as you know, comprises of a good number of global stocks, and many of them are actually linked to consumer trends, which are and consumer behaviors, which are very prevalent, not just in developed markets and developed economies, but is seen in India as well. So all the new generation companies or all the new generation businesses, whether it is social media, whether it is in general media, whether it is entertainment, whether it is platform companies like Ola, Uber, whether it is about dining out, whether it is about gaming and entertainment. All these new lines of businesses are consumer trends which are visible in India as well. So in a way, uh, uh, the two objectives are achieved. One is that you are buying global enterprises because these clearly have the kind of valuations. So whether it is a Facebook or whether it is a Tesla or whether it is on Amazon for that matter, and several other very exciting new generation businesses which are there. So they are global in scale, they are global in size, and they have been there for a very long period of time. So it gives you exposure into companies which are not necessarily just startups. They are well established and they have global penetration. The second is that many of these businesses at one level actually um, uh, you know uh, play to the strengths of emerging economies, whether it is a China or India, which is where the diaspora is, which is where the market is, which is where the populations are. So in a way, many of these companies, whether it is an Amazon or whether it is Facebook or whether it is many of these Ubers and so on, will all at one level leveraging on the markets, the emerging markets or the virgin markets, which are in some of the emerging countries. So you are buying the right vehicle, which is well established to benefit from the many of these consumer trends, and yet it allows you to play the demographics of your home country itself. At least one level, I think many of these businesses do have 20-30% of the businesses coming out of emerging markets like China and India and a few others, and over time this is only going to get larger and larger. So this is the crux of the global consumer trend funds of funds, because it allows you to a diversify your holdings, b play through a vehicle which is, and more importantly, I mean, this is a fund which has been around for a very long period of time, even in the global stable, even in our Invesco stable. It is managed by a set of managers who have been running this strategy for more than a decade. And this fund itself is 2 decades old. So to that extent, it's a very well-established strategy with a significant amount of market experience through various cycles. And I think they've done particularly well in terms of their strategies during the pandemic and subsequently as the economies in the developed markets in particular have emerged out of lockdowns. So the way they have run this strategy in a very nuanced manner, betting on the right kind of vehicles, which would benefit during the pandemic time. So when you're locked up at home, you will benefit out of things which are, let's say media and entertainment, gaming companies, and so on. And as you emerge out of the lockdown, then how do you play things which are like restaurants or travel and leisure or casinos? It has adapted itself very well during the very volatile market conditions and economic conditions that have prevailed over the last year or 18 odd months. So this is a very good offering, we think, and this is something which clearly is it is being thought of as a satellite strategy, but we think it is more than a satellite strategy. This over time will become a lot more mainstream in the lives of many of us, and this is a very good diversified global vehicle to be able to play up to that theme and benefit out of that wave that we are going to see over the next maybe a couple of decades at least.
The number of demat accounts hit a record of 14.2 million in financial year 21 amidst the COVID-19 pandemic. As a lot of Robinhood investors, they participated in equity as an asset class to direct stock investing. That was to create quick wealth kind of thing. The traditional instrument started looking unappealing with interest rates moving down. So do you think this was only one of the reasons for the markets to double since March 2020 lows? And also, did investors pull out money or redeem from equity-oriented schemes to dabble directly into the stocks? What was your experience?
I think it is, this was something which was waiting to happen in a way. It was waiting for a catalyst to galvanize it. I mean, we have all been over the last at least 10 to 20 years, thinking about the equity revolution in India, and we've had very low penetration of equities and equity ownership over a very long period of decades. So I think there was always this expectation that India as a market would evolve. India's financial savings were rising as discretionary spends went up. We reached every country in its life cycle, in its history, when it has reached a certain threshold of economic income, has been able to, as we know, generate discretionary surpluses, which then go into discretionary investments, whether it is equities or whether it is even fixed income for that matter, or it could even be any other financial savings products, pension funds, etc. So I think all that, it's just that it is confluent that we as a country reached surpassed a $2 trillion mark in terms of GDP about a couple of years ago. And that always has been a inflection point, as we have seen even in the experiences of countries like China and some of the other emerging and developed markets that we see around the world. We saw, of course, our population dynamics and demographics being also coincident at the same time that we are going to ride the wave of that very young population that sits in the bracket of between 20 and 50 years, which is something again which is very unique. And then there was this whole pandemic and the huge monetary support which came out of central bankers around the world in order to support economies, support markets, support households, support businesses. And I think to some extent we can't deny the fact that there is the importance of this liquidity in the overall equity markets and the other financial markets as well. And all this became a good recipe, and it led to the eventual equity cult that we were all expecting out of countries like India, who have been behind the curve in this regard. Well, it is a good amount of that. However, equity is not something which is a short-term game. It is not something which one can easily. Uh, well, of course, people have made a lot of money during the last 1 year, and there have been, of course, this younger fraternity of investors who have come into play, but they have not seen cycles. They have not seen the kind of market turbulences which markets are generally used to over longer periods of time. But it is good that they are, they are now uh, willing to commit resources, willing to commit their attention to equity investing. While of course this term of Robin Hood is now being used very loosely, but I think I'm sure there will be a good sub-segment of that Robin Hood fraternity as well, who over a period of time will mature as investors, who will not necessarily only resort to short-term trades. And all this is something which will bring in that experience, bring in that maturity, allow the markets to settle down. So this is something which over a period of time will become more meaningful, and it's a learning phase. There will be people who will drop out, there will be people who will lose money, but will come back with experiences of their own. And I think markets obviously will also not necessarily move with that same velocity that we have seen in the recent past. Market always goes through cycles, and markets go through cycles because businesses go through cycles. And beyond a particular point, you cannot defy, or you cannot, have a situation where markets run ahead of businesses all the while. You will have a certain stage where markets will have moved well ahead of businesses, underlying businesses, and will have to kind of come back. Or there will be situations where markets lag businesses by a significant margin and will have to catch up with reality of business. So and that will induce their cycles over a period of time. So I think they will go through those set of experiences, and that will mean that some of them will experience losses as well. But that's a part of the equity game, and that is part of risk taking. I think it will mean a lot more calibrated risk going forward into the future. So I welcome it at one level. It is not something that we have to worry about. But yes, I mean, I think in this regard, even our regulator is becoming more and more mature, with regard to ensuring safeguards which do not lead to the situations where there is a lot of loss of capital for naive investors or initial investors. I think over a period of time, many of these investors will also realize that some part of their monies need to be managed by professional managers over a period of time. And it is not something. Right now the trend is one way, but when the trends become a little more diffused and when we see cycles set in, I think the importance of committing some part of their wealth to professional managers for long-term compounding, better risk management, will come into play, and that should benefit the professional fund management industry as well. I think it's all a good beginning. It's triggered by a certain set of events, but that is how the world works. That at a certain level, it is some of those catalysts which provide that necessary inflection to become huge waves, and which lead to the complete change in the landscape.
So that's a great insight. Now, coming to my next question, several fund houses in India are perhaps taking some lessons from the pandemic, taking the count of the terrifying cyclonic storms that we have witnessed in the last few months and even years, paying heed to concerns of global warming and placing emphasis on good governance, are now approaching investments with a ESG theme. So, what drove Invesco Mutual Fund to launch this Invesco India ESG equity fund in Feb 21? And also, if you can just throw some light on the ESG screening parameters that you follow at Invesco Mutual Fund.
So again, this is in continuation of our earlier stated philosophy that we want to bring cutting edge products, cutting edge philosophies, uh, and the best global practices that are available. Uh, with regards ESG, once again, our parent Invesco globally has a very strong commitment to ESG. We have been doing investing around ESG strategies now for more than 30 years. So it is not something which is new to us as a fund house or as a global investment business. We are running more than $30 billion of assets in ESG centric strategies globally as well. We have a very dedicated a global team, a centralized global team which guides us and which formulates policies around ESG for investment managers within Invesco throughout different parts of the world. And we are in the process of streamlining, integrating, formulating one wholesome strategy, one wholesome set of practices, moving towards a certain unified ESG standard across different countries, investment centers around within Invesco around the world. So we are in that journey in a big way, and we are committing some very strong set of resources in this regard. We have certain objectives globally within the next by 2025 to get to a certain level of consistency, certain global ESG standards, uh, and yet we are providing our different investment centers around the world a good amount of flexibility to operate as well within the whole ESG setup. So while we are prescribing certain minimum standards which need to be followed by all investment centers, but at the same time we are free to devise our own product lines, our own ESG frameworks, our own ESG approaches based on local conditions, based on local requirements, and so on. And with that as a backdrop, and we at Invesco India also got that conviction to launch an ESG product of our own, and that is what we did in February 21. But we didn't jump into this headlong. There's been almost 3 years of planning which has gone into this whole evolution of our ESG practice. We started off by devising our own ESG framework, our own proprietary framework way back in 2018. We knew that this is something which we will have to spend time on. So I think it is in a way paid us off because we started off a little early in this whole endeavor. We decided to, like as I said, develop our own internal framework because we thought that it will provide us a greater flexibility of operating. There are, of course, a good number of external third-party vendor frameworks which are also available, which essentially you can use as a plug and play. We didn't really want to go down that path. We thought that we wanted to, devise an ESG process, ESG framework, which is around our existing process. So we what we did was we enveloped our existing process with an ESG overlay, and such that now at one level, all our strategies, whether it is the Invesco India ESG fund, which is the ESG centric strategy, or any other strategy for that matter, whether it is Invesco India Contra Fund or Growth Fund or Multi-Cap strategy or whichever you take, all these strategies are now enabled to meet minimum ESG standards. So at one level, I can say that all our strategies at one level are ESG aware, if not ESG centric. There is a strategy like Invesco India ESG Fund which goes a step further and is positioned as a very ESG centric strategy. But at one level, all our other strategies, all of this 22,000 odd crore of assets that we manage on the equity side, whether it is our domestic strategies, offshore, PMS, all are enveloped with an ESG overlay over and above our existing basic process, which we have been, like as I said, using for the last many years. So this is the whole. That was the whole idea. The idea was to keep internal control. The idea was to be able to be more quickly reactive with as ESG, ESG standards change. India as a country has made some decent progress on the ESG front. Indian corporates are also now a lot more ESG, centric and ESG aware. They are putting in a lot of work internally at their own end in order to meet, investors' expectations, social expectations, government expectations with regard to ESG practices. We all are doing it at our end, whether it is even us as a business. So I'm sure you as a business manager, we are all trying to integrate minimum ESG standards in one form or the other, depending upon the nature of our business. So I think the whole ESG philosophy is getting more and more prevalent, and we are happy that we have made this strong beginning. This internal process, is something which is not static. So while we have a scoring system and we grade companies on ESG parameters based on our internal framework, but it is not static in the sense that what we are looking for is not companies which are the best on ESG alone. What we are looking for is companies who are making incremental progress to improve upon their ESG scores. So what we are looking for is, in a way, what we call positive ESG momentum, such that if the ESG momentum is improving, then it becomes that those businesses become investable candidates for us, stronger investable candidates for us. So we are barring a few sectors which we are using as baseline exclusions to say that okay, we will not, in the ESG centric strategy in particular, the Invesco India ESG fund, we are saying that there are certain baseline exclusions or certain sectors that we are making in which we will not make investments. But over and above that, we are open to all other sectors. And we are open to any company in those sectors, provided our basic investment rationale and investment process is met. But we are not necessarily only saying that we will not buy companies which are not great on ESG. Uh, we look for certain combination of scores which is within our thresholds. But what we are more excited about is companies which meet a certain minimum standard and yet are making efforts to improve upon their ESG scores as well. Because we have a firm belief that as ESG businesses become more and more ESG sensitive and ESG aware and improve and do things which are positive ESG momentum, these businesses will get re-rated and revalued by market participants, and vice versa as well. If there are companies which slip on ESG or develop negative momentum around ESG on account of any of their practices, whether it is to do with environment, social, or governance, then it can become a case of derating as well and devaluation as well for that enterprise. So we are looking for both. We are looking for partnering and increasing our ownership of companies with positive ESG and positive ESG momentum, and yet we are careful about making sure that we are not as exposed, or we are cutting down on companies which are negatively exposed or probably developing negative ESG momentum. So that's the underlying philosophy of our fund. What we do is that we are using at a very base level, giving a short description here. We use the business responsibility report, which is mandated now by SEBI for at least the top thousand companies in India. Today it is 500 companies, but it is going to be extended to the top 500,000 companies in the next by March 23. So all these thousand companies, top thousand companies, are supposed to carry what is known as a business responsibility report, the BRR, in their annual reports. And this is a starting framework of which on which companies are supposed to illustrate what they are doing or their efforts with regard to ESG. We use that report as a starting point to understand companies' philosophies on ESG. We do our own analysis of those several parameters which are prescribed in that report, and companies' actions, corporates' actions with regard to those parameters. We then, our analysts in the respective businesses, the respective industries, then score these companies on each of these parameters, E, S, and G. We then try to arrive at a combined, numerical score for each of these companies. What we have is an inverted scoring mechanism, so which is essentially between a range of 1 and 3. 3 being the worst in terms of ESG scoring, and 1 being the best in terms of ESG score. So it's a reverse scaling system. uh, what we do at a baseline level across all our strategies is that we do not invest in any company which has a weighted average ESG score of anything more than 2.5, 2.5. So any company, the score of which is more than 2.5 is automatically excluded from our investments in all our strategies. For our ESG centric fund, which is the Invesco India ESG fund, we have made the standards a lot more stringent. So we are saying that instead of 2.5, we are going to not buy into any company which is more than 1.8 and on the weighted average score. And more importantly, the individual parameters E, S, and G, all the three have to be less than 2 as well. So none of these parameters can be more than 2, and the combined score has to be less than 1.8. And that is how we have made the standards for our ESG centric fund lot more stringent. So, in general, this is in short, this is a very high level view of our scoring framework and how we approach it. But the important thing I want to stress upon is the fact that all of it is done internally. It allows us to have better control, like as I said. It allows us to react faster. So if companies improve upon their ESG, then we should immediately, our team has to be able to capture some of those elements, immediately come up with a revised score, uh, assess whether that company was earlier 2.6, but now it has become 2.3, and therefore it has become investable. Then we can immediately action it in our strategies, benefit from the re-rating possibility, and vice versa as well. Whether if it develops any kind of negative momentum, also, then we should be in a position to react a lot more quickly. If we are using third-party frameworks, then we have to be at their mercy because they might do it at the end of a certain quarter or a certain appointed date, and that may necessarily create market distortion. So I think it allows us a lot more flexibility, a lot more agility to be able to act faster and benefit from the same. So I think in general, I mean, there's a long-winded answer, but I thought it would be good to give the audience a flavor of what we do. It's a lot of work which has gone behind. We have developed this framework. We have in fact gone through a version 2 as well. So we started this exercise in 2018, like as I said, but in early 2020, in the height of the pandemic, in the middle of the pandemic, we improved upon this strategy. We came up with a second version, and this is something which will be a continuous process in the future as well, because ESG is an evolving stream. It's an evolving practice, and nations are adjusting to that. Corporates are adjusting to that. Individuals are adjusting to that. Regulators are adjusting to that. Investors are adjusting to that. So it is something which we are learning through. We will have probably a few more versions as we go along, as things become a lot more stringent, as our understanding sharpens. But I think we have it's a journey which is well begun, and we are happy that we are probably ahead of many of our peers in this regard.
So that was quite comprehensive insight on the ESG parameters that you follow. And
Thank
the
you.
parameters are very stringent to select some of the best companies on the ESG parameters. Now, coming to my next question, we are in the strong second wave of COVID-19 currently, and daily new cases have surpassed the last peak of September 2020 that we had seen, while we recently had even crossed 37 lakh active cases. And while India is still way behind in its vaccination drive compared to other countries, and medical experts, they point out at the possibility of a third wave in India around August or September this year. So, are you worried that this might weigh on the Indian equity markets and disrupt the wealth creation process? As one who follows a contrast style and believes in going against the grain, are you seeing an opportunity in this adversity?
So I think fair question, and we started off believing even before the second wave hit us that there is an adversity and which can become an opportunity at the beginning of 2021, or let's say later part of 2020, when we thought that we started to recognize and understand that look, uh, many of the if I were to rewind back a little bit to even end of 2019, we as a house and in our thinking, we were of the view that India could commence on a better economic cycle in 2020, 2021, and beyond, compared to what we had probably seen in 2018-19, based on certain things that we were seeing in the economy at that point in time, whether it was regard to the banking system gradually exiting out of the non-performing asset cycle of 5 to 7 years. The fact that the rural economy was on a mend. The last but not the least, the fact, I mean, two more factors. In fact, one was the fact that interest rates in India were consistently coming down, and last but not the least, the fact that the government too was for a reasonably long period of time once again focused on the economy. So all these things made us believe that India could commence on a better economic cycle. Unfortunately, COVID hit us. But when we sat back again in even late part of 2020, once the economy started to kind of uh, emerge out of the lockdown and settle down and uh, uh, go back to normalcy, we saw that many of the starting factors that we were thinking about in 2019 were still reasonably valid, whether it was the banking system's ability to have managed the pandemic well, whether it was government reforms which were continuing, whether it was interest rates which were continuing to fall, whether it was a rural economy which was reasonably resilient, even particularly in the first wave. So we felt that most of the parameters are valid, and as we settle down with regard to the pandemic, the initial premise of the resumption of India's economic cycle, better economic cycle, should once again commence. Unfortunately, we got interrupted by the second wave, uh, and we all know that we have had our lapses as a nation, as individuals as well. Uh, uh, so we are aware of that, and as a result of which, we have had to pay a price in the last 2 months. But I think there's always a positive offshoot or an upshot of uh, these dark days as well. And the positive upshot this time around is more than the vaccine. I would say is the fact that we all, as citizens of this nation and the government and the administrative machinery around it, is all going to be a lot more alert and a lot more aware of our responsibilities going forward. So I think if we've had some loose behavior or inappropriate behavior in the last 6 odd months, and we have taken this a little more lightly last time around, I think that's probably not going to be the case. So there will be this learning. Government's efforts probably have redoubled in the last couple of months. I think we will have a lot more preparedness and readiness, even if, let's say, a third wave hits us. We are working on the vaccine. We are not in full flow at this stage. We have certain handicaps, but it's getting better by the day. Vaccination rollouts and administration of the vaccine is increasing on a daily count. We need to even double from here, but let's say we are already kind of on an upward trend. So maybe we were administering something like 1.5 million doses a day a few weeks ago. We are now administering more like 2.2, 2.3. We probably are looking forward to maybe a 10 million mark in the coming few weeks on a daily basis. I think if and anecdotally too, I think all of us are experiencing that there are many more, a wider section of the population is getting vaccinated, and there are many more forums and there are many more setups and vaccination centers which are emerging in our vicinity, in our offices, in our buildings and premises. So that's clearly anecdotally visible. We need to do a lot more, but I think the trend is clearly in the upward direction. uh, so a market is clearly sensing the fact that vaccination will improve, uh, even at the current level of cases which are happening. I think, and the fact that roughly about 15 odd % of the population is already vaccinated. Um, the next 6 months we should reach a reasonable level of herd immunity through a combination of the fact that many of us would have uh, got infected one way or the other, asymptomatically or symptomatically. Um, we would have been administered a vaccine as well, whether a single dose or maybe 2 doses. So I think there is a fair chance that we will reach 60-70% immunity levels as a nation in the next, say, by the end of this calendar year. And I think when we look at it as an versus other countries, when we look at examples of countries like the US or UK, and even countries like, let's say, Israel, for that matter, and a few others, who have had very good, systematic vaccine rollouts. They have seen a sharp correction in their second wave, their ability to control the virus, active cases, etc., etc. So I think it's very clear from the experiences of many of these countries, and I think a similar uh, thing should unfold in India as well. So I think we, we are not, this is not to say that a third wave cannot happen, but I think the lethality of the third wave, the fact our ability to control, our ability to ensure that our health infrastructure is reasonably better compared to what happened in the second round. Uh, Alertness of the central government, alertness of state governments, alertness of all of us as individual citizens will be a lot higher in the next round compared to what it has been. And so, this is the virus, the pandemic is not something which is going to disappear overnight. We have to kind of maybe continue to live with it over the next few years. But I think we can reach a stage where it does not interrupt daily life and daily economic activity. And I think that is what the market is also hoping for. Any kind of detraction from this stated plan or this stated, expectation out of the market is something which will be a source of negative surprise for sure. But for now, I think we have our guards reasonably up, and I think that should make sure that we're able to manage the situation reasonably well. It is not to say that the whole problem is over, like as I said. It's about our ability to manage, and I think our ability to manage the next time around will be a lot better than what we have seen probably in the first wave, and then in definitely during what we've seen in the second wave.
So, which sectors or themes, in your view, will lag, and which ones will be the ultimate winners as we navigate the wave of COVID-19? And how are you currently approaching the defensive versus cyclical story amidst the pandemic?
So, in a continuation of what asked me in the previous question as well. So we are positioning ourselves, like as I said, for a better economic cycle over the next 3-4 years compared to what we've seen in the past 2-3 years on account of various reasons. Globally, too, we are of the belief that we are at a stage where economies are reflating globally, emerging through the pandemic, emerging out of the lockdowns, and resumption of normal economic activity. And this should generally benefit a larger section of businesses. Uh, there is a distinct difference between what did well during 2020 and what is doing well in what we are now seeing in the first few months of or the first half of 2021. Uh, 2020, as I said, was more about buying safety havens, buying growth companies, which eventually should be able to grow one way or the other. Buying safety of balance sheets, not buying as much of possibility of growth. Uh, 2021 is different in the sense that the market is willing to be a lot more, risk loving versus the risk averseness, which aversion which was seen in the last year. It is not about protecting yourself against balance sheet risk alone. It is along with which it also wants to see businesses which can take advantage of the resumption of the economic cycle and be able to grow as well. It is not about buying safety of businesses at any valuation. It is about taking risk and buying decent quality businesses, but which are not expensive, maybe a little bit cheap, and are likely to uh, deliver earnings surprises. So the expectation of earnings growth, expectation of earnings surprises is what is guiding the market behavior in 2021 versus last year, which was more about defensiveness, sitting on the sidelines, just being with some of the high quality franchises. Whether they grow in the near term or no is not an issue, but with the belief that eventually somewhere down the line they will grow. So there is a different complexion to the market in 2021, uh, and it has brought into it has brought into focus this whole uh, divide between growth and value stocks. Clearly, last year was about growth. This year it is about value at reasonable price, a value which can turn into growth eventually. And we too, as a house, are of that view that value should do better in the course of 2021 and maybe extend a little bit into 2022 as well. Growth oriented companies will come back, but perhaps towards the later half of this year or towards the end of calendar year. Therefore, our preference in the more recent months, starting, let's say, calendar year 2021, has been towards sectors which are in a combination of industrials, commodities, infrastructure related plays, manufacturing related plays, those which are going to benefit probably out of even global trends, because global scenario is relatively better compared to the domestic setup today. We are going through this second wave, and we will take a little bit of time to stabilize. We have a situation where some of our uh, growth constituencies are affected, such as the rural community, etc., is a lot more affected this time around. So I think we have to be cognizant of that. It will come back, but it will probably take a little bit of time, maybe a couple of quarters away from now. In the meanwhile, the whole of the industrial setup, the global cyclicals, the manufacturing led enterprises, infrastructure related beneficiaries are something which will be in focus, and we have fine tuned our portfolio stances to be able to accommodate and represent those. Uh, from a sector standpoint, therefore, things like financials is something which is a very important value play at this stage. It is linked to the economic reflation. It is a sector which has gone through a lot of pain. It can be a sector which will probably have amongst the highest earnings CAGRs in the next 2 or 3 years. It is at valuations which are very comfortable, and the sector strengths, inherent strengths, intrinsic strengths have become better in the last 2 3 years due to accelerated recognition of bad assets, and the fact that they've also strengthened themselves through infusion of a decent amount of capital. So they are all in a state of preparedness. They have emerged out of a very big event like the pandemic reasonably well, in terms of being able to control credit costs and credit behavior. So I think that is a very central. We believe that, and that is where we are reasonably strongly positioned. We are adding to our weights in that. Some of the industrials is another area where we are having a decent amount of active overweight through many industrial stocks and manufacturing related enterprises. We are reasonably excited about certain commodities as well. So that is where we are placing more of our incremental bets. Having said, I would say that at one level, we don't go to any extremes. As a house, we follow a very balanced strategy. We do veer towards one end or the other to some degree, but not to extremes. So we keep a reasonable balance and tweak our strategies along the way if need be. A little bit of tactical allocations could happen, but by and large, we maintain a reasonably balanced profile. So we are not saying that we are out of growth companies. We have a fair bit of exposure to growth oriented firms as well, but we have to be cognizant of where the appetite and the earnings surprises are going to come about higher than elsewhere, and that is what decides the final balance of the portfolio. But in general, I think our design of our portfolios is largely balanced, such that we don't really want to end up with outcomes which are significantly out of sync with the market reality for longer periods of time. We can have 6 months, 3 quarters, 4 quarters where we might be distanced from the market, but we don't want a situation where for 3 years, 5 years in a row, we've never had that situation. We are significantly distanced from market reality. So I think that is what we eventually bear in mind.
So coming back to valuation, do you think that we have run ahead of the fundamentals, or do you believe that there is still a decent amount of margin of safety left in terms of valuation?
Well, we are at valuations which I would call as fair at an aggregate level. We are not very overextended either.
Mhm.
Uh, we will have to calibrate it along the way, because we are going through an unusual phase of our lives and our economies and the markets as well. So we'll have to fine tune along the way. There could be earnings surprises, positive surprises. There could be temporary earnings disappointments as well. So we are going through that bit of phase for the next maybe a year or year and a half. But I don't think we are at valuations which are so elevated that we just can't operate. I mean, I think we can rationalize quite a number of companies. We can rationalize the valuation of many companies, even in the light of not just the earnings surprises, but the fact of cost of equity and cost of overall cost of doing business in general, which is falling. Interest rates where they are, and if you juxtapose interest rates with valuations, we've seen a 200 basis points at least decline in interest rates in India in the last 2-3 years compared to the prior decade. And that is something which does merit being a little more accommodative on valuations as far as possible. But again, we have to approach it. So I wouldn't say that valuations are extreme. There are pockets of extremity. There are also pockets where there is value. So we are approaching it from a very open-minded structure. We are making sure that at the portfolio aggregate level, our valuations are not something which are significantly destructive or significantly demanding, such that investors will find it difficult to enter into our portfolios. In keeping this balanced approach, in whether it is in terms of sectors, whether it is in terms of market cap, whether it is in terms of combination of growth and value, whether it is in terms of certain expensive stocks versus some possible re-rating candidates, I think this overall balance is something which is what we have our eye on more than the individual, more than at a very broad level thinking of just valuation that, okay, I look at the Nifty valuations at 23 times or 24 times and I don't work. I wait for it to correct to 20. That is not the approach. We have to be open to the reality. We have to be open to opportunities which come in front of us. But at the portfolio aggregate level, it has to be a balanced outcome. If that being the case, then I think, again, with the whole idea that over a 3, 4, 5 year time frame, we should be able to generate, reasonable risk-adjusted returns. Not just absolute returns, but reasonable risk-adjusted returns, and at all times trying to make sure that we don't end up with fatal losses. So I think that's our basic operating principle around all kinds of conditions, and we have got thoroughly stress tested on our investment process and our approach and our mindset in the last 2 years of this pandemic.
So, in general, what will be your advice to investors amidst this pandemic and otherwise? And how can they be smart investors and make investing a habit so that it serves to them in their interest of building a long-term financial well-being?
Well, I think there is no two ways about the fact that, look, this is investing is something which is essential. I mean, it is as important as having a meal every day and taking good care of yourselves, taking good care of your families, taking all kinds of safety measures for one's health. I think investing is equally important and equally critical for not just your own health as well as your overall well-being, but also for the well-being of your family. So I think you don't have a choice in accepting investing as a reality as early as possible. I think there's also no two ways about the fact that, look, this has to be a long-term view around this. Investing has never been about short-term, despite the fact that people might, some of the newer generation of investors may feel that they've made a lot of money in the short run, and that it therefore means that equity is very easy or investing is very easy. I don't think they have gone through that cycles, and or they should prepare themselves for that. So I think that's another important thing, that please prepare for bad times, please prepare for market cycles, please prepare for economic cycles. If not now, maybe for 2 years later, or as and when it appears. So I think the way your savings design is, your architecture of your incomes is, how you set aside your non-discretionary and discretionary spends, all has to encompass and take risk into account as well. Equity investing is not only about returns, it is about risk as well. But the exciting part is that, I always see this whole game as, it's like a magic box. I mean, it's a magic box where you put in something and today, and you don't know what you will end up 3 years down the line, or 5 years down the line, or 15 years down the line. That magic box can spring enormous surprises. So keep putting money into this magic box because it always delivers over the long term, and you'll be surprised at what the outcomes can be. So I think do not think of yourself as someone who has all the tools at his disposal because you have made a lot of money, or the markets have made you a lot of money in the last 6, 8, and 12 months, and therefore one should not start believing that one has become a pro at it. Be humble. Markets will humble you at some point in time. Okay, be flexible, be humble, and only then will you be able to be in this activity for the longer haul. You want to be in the game. You don't want to be thrown out of the game. So don't do anything which throws you out of the game. Do things which allow you to stay in the game. You will have losses, you will have reversals. Take that as a given. But be reasonable about your losses. Develop the ability to have reasonable losses so that it allows you to stay in the game for a longer period of time. This is what I can think of at a very generalized level in terms of how investors should approach things and think about equity markets in general.
So that was a great insight and guidance for our investors. So with this, thank you, Tahir, for your valuable time and insights. And I'm sure the investors will immensely benefit from your views. Thank you so much for being with us.
Thank you, Vivek, for once again having me. And audiences, please bear with me for some of the interruptions and the noises that you can see. It's a nice weather out here, wherever I am, but it's probably also created some interruptions in between. But I hope all of you like and hear what I've been able to communicate. And best wishes to all of you. Please stay safe and take care of yourselves.
Thank you. Mutual fund investments are subject to market risk. Read all scheme related documents carefully.